thank you for joining our webinar, Investing for the Long Run, brought to you by Tandia Wealth and proudly sponsored by Mackenzie Investments. I'm Russ McKay, Tandia's Director of Wealth Management, and I'm excited to guide you through the next 30 minutes or so. Whether you're a seasoned investor or just starting your journey, we feel that this session will provide a lot of valuable insights to you in regards to what we feel are sound investment practices and all of the many advantages our members can receive by working with a wealth advisor. If you have any questions during our webinar, please use the Q&A function. We'll make sure to address them. And if for any reason we can't answer your questions during the session, rest assured we'll follow up with you via email afterwards to provide assistance. So with that, let me introduce you to our speakers. First, we have Emma Pozzula from Mackenzie Investments, a seasoned investment manager who collaborates very closely with our team. Emma boasts a strong track record in building relationships and crafting effective investment strategies. Also joining us, we have Khush Dhaliwal, an investment advisor dedicated towards our Tandia members. Khush has over a decade of experience in financial services, and he specializes in safeguarding our members' capital, fostering growth, financial planning, guiding our members to retirement, and also guiding them through retirement. So without further ado, I'll hand the mic over to Emma to start us off.
Thanks for the introduction, Russ. And thank you all for joining us tonight. I'm going to be talking a little bit about markets, the psychology of investing, some strategies to combat the natural volatility of markets, and I'll conclude with some key takeaways of the power of staying invested. Markets will always climb a wall of worry, and historically we have seen many periods of increased volatility, some of which you can see on the screen here. The global financial crisis that I'm sure many of you remember in 2008, 2009, and most recently the pandemic sell-off in 2020. Yet markets continue to be resilient. Although I know as an investor it can often be difficult emotionally to stay invested in these tough times, as you can see, most investors actually do the opposite of what you should do, and that is they buy high and sell at a low. But many of the strongest returns in markets actually happen immediately after a sharp decline. So those who exit at market dips actually miss out on this sharp increase. And you can see in this chart here, the navy blue bars, that is the average gain in an up market, also known as a bull market, and that is 165%, whereas the average loss in a bear market are those small orange blips on the screen there, and that's only negative 34%. So what are some strategies to combat this? Firstly, we want to avoid trying to time the market. It is virtually impossible to know when markets are going to rebound, and the most important thing is to stay the course so you don't miss out. So I want to show you this exact example on the screen here. So let's say you had approximately $5,800 at market bottom on March 31st, 2009. And let's say you decided, I can't handle this anymore. I'm going to pull out and move into a GIC. 6 years later, that money would have been worth about $6,600. Now, let's say you spoke to your investment advisor and you just left your money in the market. You didn't touch it. 6 years later, it would have been worth almost $17,000. Now, let's say you decided to invest another $10,000. 6 years later, it would have been worth almost $50,000. So that's a pretty big delta between the two. We also want to keep a well-diversified portfolio and invest in different asset classes, as we don't know which asset class is going to outperform in any given year. So you can see in this chart here, this is known as a jelly bean chart, and it shows the best performers at the top to the worst performers at the bottom in each asset class in any given year since 2008. So why is this important? It's important because you can see there's no pattern, right? So in our investment portfolio, we want to put our eggs in different baskets. So each year we will have some outperforming products. So some key takeaways. Markets will always recover, even if there are bumps along the way. So you can see in this chart that as of 1989, the annualized return on the S&P 500 is 11.34%. Double-digit returns, including all of the crises, you can see on the right-hand side there. So no matter what, if investors stay the course, they will recover from volatile markets. I also want to touch a little bit on GICs. Now, GICs can be a very important savings tool for some, but for others, there may be some other investment solutions that may be more suited to their needs. That is why I highly suggest that you meet with a financial advisor to discuss your options and see what's best for you. Now, looking at in a long time horizon, you can see here on the screen that a 1-year GIC in the orange after tax and inflation may actually provide you with a negative real return. I also wanted to lay out some key differences between, your average 60-40 mutual fund portfolio, that's 60% equity, 40% bonds, over a GIC. So the first main difference is liquidity. You have much higher liquidity. You can move in and out in a 60-40 versus a GIC. You're often locked in. Tax efficiency. A 60-40 portfolio is often more tax efficient. A GIC, you're going to be taxed at your highest marginal tax rate. There's no withdrawal fee on a mutual fund versus a GIC. There may be. And then there's a lot bigger upside potential on the 60-40 portfolio versus GIC, which I'll show you in the chart in the next slide here. And again, we're looking at a long time horizon, not necessarily a short one. So here we're showing investment growth over 20 years, a 60-40 portfolio, just bonds, and then you can see GICs as well. So again, looking at a long time horizon, it's best to meet with an advisor to discuss what will best suit your financial needs. So that's all that I have in my portion here. Was just going to pause for a second to see if there's any specific questions for me. And then if not, I'm going to be passing it over to Khush for him to lay out his portion. So we'll just take a pause. I'm going to take a look at the Q&A. I think we are good to go. I'm going to be passing it over to Khush to take it away.
Thank you, Emma, for providing us with objective data and useful information to help investors make the right decision. And also thank you, Russ, for the introduction earlier. And a special thank you to all of our guests for this event that took out their time this evening. Really appreciate it. For those of you on this call today who are not familiar with myself, Khush Dhaliwal is my name, and I work as an investment advisor with our Tandia wealth team. My role as an investment advisor is to create, manage, and protect our members' wealth. Most importantly, I work with families and individuals to efficiently plan for their financial future. Today, our topic of discussion is long-term investing and the value of working with an advisor. We will begin today by addressing why it is important to invest for the long run and the challenges that investors face in today's market. Recently, a hot-button topic that Canadians are talking about is inflation and rising interest rates. Inflation and rising interest rates are a challenge today for many Canadians because majority of Canadians are having a hard time keeping up with the increase in cost of living over the past couple of years. However, in reality, inflation has always been around, and it is the one constant factor that is always in our economy. It's always been there, and it will continue to be present. In order to preserve and grow wealth, it is important to understand the impact that inflation has on your purchasing power. In other words, $100 5 years ago would buy you more gas and groceries than $100 spent today. And now it is okay to have funds in short-term investments or cash or GICs if you have plans to spend that money in the short term. However, keeping your hard-earned money in cash or guaranteed investments over an extended period of time or a longer period of time may lead to a significant loss of purchasing power. Just the other day, I was driving and listening to the radio, and I heard a pizza commercial on the radio that was talking about a fixed rate pizza, so that pizza prices won't get jacked up. Unfortunately, that is not true for everything else that we need for our day-to-day existence. The simple solution to keeping up with inflation and also beating inflation is to buy quality stuff. Now, what do I mean by this? Buying quality stuff could mean buying a business or a piece of a business. It could also mean buying luxury goods or real estate or purchasing any quality investments. Having said that, it is important to have your hard-earned money working hard for you. Working with an advisor can help you determine what kind of quality investments are right for you and the best option for you to allocate your capital so that it is continuously growing and beating inflation. Now, in addition to inflation, investors face an inherent challenge, which is investor behavior or attitudes towards the market and the economy. Now, I truly believe that we are part of an overall productive economy and that over time, the global economy is positioned for significant growth. And history has shown us this. However, the problem is that most humans are hardwired to fight or flight when it comes down to a moment to make a tough decision, especially a decision that will significantly impact one's financial future. Now, when the markets are selling off and times are rough and the markets aren't doing well, the emotional investor will choose to not invest and rather sit on cash. It is very interesting to see that the stock market is the only place where people will run out of the store during the sale or when you're being offered essentially a significant discount. Now, for example, when people are shopping on Black Friday, everyone is typically happy because they're getting deals, they're saving money, they're getting discounts. However, Black Friday in the financial markets, it's perceived very negatively. But logically, in reality, this is the time to back up the truck and load it up. Therefore, it is important to be aware and educated about how one's emotions can impact important decisions and as a result, impact your financial future. So working with an advisor can help you stay on track, not get emotionally distracted with short-term ups and downs, and most importantly, having a conversation with your advisor about how you feel and getting reassured that everything will be fine can go a long way. To add to that, having a framework or a plan in place with your advisor can help eliminate emotional decision-making. Now, the third challenge is investing efficiently. In today's world, we have thousands of options for investing, and the internet provides access to tons of information. This can become a challenge as information overload may lead to many inefficiencies or may also cause paralysis by analysis. In other words, if we have too much information available to us, we might not know which information is useful and reliable or which information is useless and really a distraction. So working with an advisor can eliminate this challenge as your team of professionals will diligently share with you options and information that is beneficial to you. Not only does this help you make the right decision, but it can also save you a lot of time and energy that you can spend elsewhere. Now, ultimately speaking, long-term investing and working with an advisor over an extended period of time can help you combat inflation, manage your emotions, and access the right information to make the best possible decision for your financial future. Most importantly, working with a professional advisor can help you achieve your goals more efficiently and effectively. And having a framework and a tailored plan in place will provide you with direction and confidence in achieving your goals. Your plan should include quality investments that will work towards your investment objective and operate within your risk tolerance. And finally, your plan should be monitored on a regular basis to make sure that you are on track to achieving your financial goals. Now, here's an interesting slide. There was a study done by the Serrano Group, which compared the growth of assets for households that were working with professional advisors and households that were not working with any advisors. The study ultimately concluded that households that worked with professional advisors over time had 4 times more assets than households that did not work with any advisors. This graph essentially outlines the value of working with an advisor over an extended period of time. So here's a real life example, a case study of one of our members. As you can see at the bottom of the page, we have added around $1.5 million of value to this member's financial situation by putting together a detailed plan to help them achieve their financial goals and provide them with direction and confidence. Not only will they be in a position to achieve all of their financial goals, but they will also have $1.5 million more because they are choosing to work with us and plan for their financial future. Now, I understand we have discussed a lot of material in today's presentation, but if there's one thing I would like you to take away from this is that you should always have your hard-earned money working hard for you and not sitting idle. So thank you very much, everyone, for your time today. It is much appreciated. We will now proceed to the Q&A part of the webinar. Over to you, Russ.
Thank you, Khush, and thank you, Emma, for all your insights. Again, if you have any questions, please use the Q&A feature. We'll answer a few questions over the next couple of minutes. And again, should we not be able to answer your question during the session, again, we'll reach out to you via email afterwards with some help. Keep in mind, you can also reach out to one of our investment advisors, such as Khush, by going through our Tandia website in our wealth section, or the QR code on the next screen, which we'll get to in a minute. So let's take a few moments here to answer some questions that we've had come in so far. The first question we have here, can I lose all my money? So I'll leave that one to you, Khush.
Well, investing is really different than gambling. When you go down to Niagara or to the Brantford Casino, there's a good chance that you can lose all of your money. However, if you are invested in quality companies and a properly diversified portfolio with risk management strategies, you will significantly reduce the probability of losing money over time. So Russ, to answer this question in short, no, you will not lose all of your money if you work with us over an extended period of time.
Good. I have another one here. I have some investments elsewhere, but I don't hear from my financial advisor there very often. Does Tandia Wealth offer second opinions? If so, is there a fee for that?
Yes, absolutely. We provide second opinions, and no, we do not charge upfront for this. There is no one firm or one person that has a monopoly on good ideas. Therefore, I strongly believe that sometimes getting a different perspective can ensure that you are not overlooking anything or missing out on anything. More importantly, when you speak with one of our advisors, we will provide you with an unbiased and objective second opinion.
Thanks.
Just to add to that, sorry, Ross, sorry to interrupt, but just to add to that, if you were moving funds from another institution to Tandia, we don't charge a fee for that as well.
Perfect. Thanks, Khush. It looks like we've got quite a few questions coming in, but we're good for time, so I think we'll keep going here. Are there tax implications for transferring registered products?
Great question. The short answer is no, because most of the time when we transfer registered products, we transfer the account as is. So it's not essentially a new account or a new, well, it is a new account, but it's not that you're starting a new RSP, for example. Your RSP remains as it is, but instead of your previous firm, the statement will say Tandia.
Perfect, thanks. I have another question here. I think it's more of a subjective question. I heard it's better to invest in the bond market and GICs right now. Is this true? And I'd say this is a pretty valid question right now, just given where GIC rates are at the moment.
Yeah, it is a good question, and interestingly enough, it depends case by case, depending on your personal investment objective or your financial objectives paired with your risk tolerance and your appetite for risk. It might be the case that neither makes sense. So it really comes down to the individual person or case to really provide a more accurate answer to a question like this.
Thanks, Khush. I have another question here. It's a two-part question. Do you need a lot of money to get started? And what do I need to get started?
So more importantly, the thing I like to say to majority of our members is I need to be the second most interested person in your financial affairs, and you need to be the first most interested person, which essentially means that to get started, the number one thing you need is commitment, not the idea of getting started. It's the commitment of getting started. And when it comes to a dollar amount, really that once again, Russ, comes down to each individual cash flow, capabilities an investor has. So there isn't an exact amount. We do not have hard thresholds at Tandia. We work with individuals from all walks of life, business owners, retirees, individuals that are, starting off in their careers, entrepreneurs. So really, we work with everyone.
Thanks, Khush. I have one more question here. How often should I be adding to my investments?
Well, the short answer to that, Russ, is as often as possible. And the reason for that is the phenomena of dollar cost averaging. For example, investing a chunk of lump sum money on day one versus investing, that portion of money split into 10 different portions over 10 different months, will provide you with a better price. So over time, you can reduce your, average cost so that you get a better price, and over time, your portfolio does well.
Thanks, Khush. And it looks like we have a couple more have come in here. If I have a room in my CFSA and my RSP, where do you feel I should invest first?
Well, once again, it comes down to each individual scenario. However, we do emphasize on maxing out your TFSA first, just so that you have the flexibility of having access to the funds and having essentially no tax implications. Whereas your RSP, God forbid, you need the money sooner than you expected, then you would essentially have to pay withholding tax on the money you withdraw. Whereas a TFSA, you can withdraw your money at any point in time without paying any taxes. And here's the thing, the following year, you can recontribute that money back into the TFSA. So essentially, when it comes to flexibility, the TFSA is definitely a lot more flexible than the RSP. However, each registered solution has their own place in a portfolio.
Thanks, Khush. If I had a financial emergency, would I be able to access my funds quickly?
Once again, when we plan for our clients, we always have contingencies in place. So, for example, a rainy day fund or an emergency fund. And generally speaking, most of our investments are liquid. So yes, the short answer to that is yes. If you have a financial emergency, you can access your funds at any point in time. Now, there might be tax implications. There might be, it might not be the best time given where the markets are at. But yes, you can essentially access your funds quickly.
Thanks, Khush. What is a spousal RSP?
So essentially, spousal RSPs are set up for couples or in a scenario where one spouse is earning significantly more than the other. So that way, they can utilize the RSP room within their spouse's RSP and essentially save over the long term.
Let's see here. What about stock that pays dividends? Is it to my advantage or disadvantage? And how does it impact my taxes?
Well, just a personal opinion, I love stocks that pay dividends. That means that that company is in good financial health. Companies that are paying dividends over time and the dividends are growing is a great sign. And so generally speaking, earning dividends is great. Now, when it comes to tax implications, dividends are taxed lower than interest income, so GIC, but they are taxed higher than capital gains. So if you're talking about extreme tax efficiency, then capital gains is really the way to go. But again, depending on your situation, dividends can make sense. But generally speaking, I love dividends. It's like owning rental property, right? You instead of having to worry about tenants and maintenance of the home, you have a company that is paying you monthly or quarterly without, despite of what's happening in the markets. And that's the best part, because dividends, what I like to essentially say is you're getting paid to wait for the markets to recover when they're down. And when the markets are doing well, that's great, because the markets are doing well and you're getting paid dividends at the same time. So at that point, it becomes a win-win situation. Hope that answers your question, Russ.
No, that's great, Khush. I have a few good ones here. Member would like to know, when should you convert your RSP to a RIF? Maybe you could touch on that a little bit, Khush.
So typically speaking, it is the year the end of the year where you turn 71, and you would convert your RSP into a RIF, and now you would be obliged to withdraw a minimum amount that the government of Canada determines. Now, you can convert your RSP into a RIF before that as well. However, it depends case by case. We would need to further explore exactly what the overall situation is and if that does make sense. But absolutely, you can convert it before the required age of 71.
Thanks, Chris. I have a good question here. I know you and Emma both touched on investing regularly, so I think this kind of adds to that. Is there an ideal percentage of someone's paycheck that you would recommend they set aside each month to invest?
Well, I would like to begin, you can use a bucketing strategy for this. So you have one bucket where you have your essentials. So your hydro bill, your mortgage, groceries, keeping the roof over your head and food on the table. Once that's taken care of, then there's essentially two buckets left. One is your savings and one is discretionary spending. So again, this comes down to each individual's own preference. However, we definitely recommend that, a good portion of your paycheck should be dedicated to that bucket of long-term savings so that ultimately you're able to live your desired lifestyle down the road and really grow your money instead of just spending it on things that you really don't need or essential needs, right? And then, you have a smaller portion towards your discretionary spending where you can go on trips or, have dinners out and do things that, you really don't need to do, but you enjoy doing.
I think we got time for two more. If I have extra cash, I think this is a great question just with mortgage rates going up. If I have extra cash, should I focus on paying down my mortgage or should I invest in the market?
Here's the thing. Having extra cash and paying down your mortgage is always prudent because, I like to say that I'd rather be on the side of the equation of earning interest than paying interest. Now, given, where the markets are currently at and plus the amount of cash you have available, like let's say if you have 500,000 versus 5,000, that could definitely play a role into, how this question should be answered. But generally speaking, I like to say pay down as much as debt as you can first, and then focus on building your portfolio and your nest egg.
Thanks, Khush. We'll answer one more here and then we'll wrap up. Maybe a difficult question. Will increasing inflation continue to affect my investments?
100%. Like I said, inflation is a silent killer. It's always been there. It will continue to be there. And that is why it's important to have your money working hard for you. And you do that by buying stocks, buying quality investments, investing in companies. Let me give you an example. So inflation's rising and companies are actually doing really well. Some of the companies out there are resilient, as Emma had alluded to in her presentation, that, especially the S&P 500, over time, it has, come out on top with double-digit numbers. And so that is the one way you need to focus on beating inflation, is to investing your money. And yes, even when inflation is at the target rate of 2%, 2.5%, 3%, it's still there. So generally speaking, when investors are calculating their rate of return, there's a lot of mental math. If I get 4% and I pay some taxes, I'll be left with, maybe 2 or 3%. However, very rarely do people factor in inflation. And that is what Emma was showing on that one chart, that over time, net of inflation and taxes, tax and guaranteed investments, don't do too well compared to the stock market, really, the S&P 500, or quality companies like Enbridge, Royal Bank, just to name a few. So yeah, to answer your question, yes, inflation will impact your cash over time.
Thanks, Khush. Appreciate you answering those questions. Those were a lot of great questions. With that, I'm going to wrap up. So I just want to give a heartfelt thank you to Emma and Khush for their valuable contributions and their commitment tonight and answering all those questions. So we really appreciate both your time and insights today. So with that, I'll conclude our session. Once again, thank you everyone for joining us this evening. We trust that you found this presentation both informative and beneficial, and please keep an eye out for an invitation to our November webinar hosted by Doug Carroll from Aviso on the topic of estate pre-planning, something we're really excited for. So with that, I'll close this out, and please enjoy the rest of your evening.